Hello everyone, and welcome back to Explain the Charts. Today, September 14th, 2025, we're taking an in-depth look at the EURUSD currency pair, examining both the recent news and its impact on the charts. The US dollar's performance has been closely tied to inflation data and employment figures, with recent reports indicating limited movement after inflation met expectations, yet some underlying weakness due to disappointing job numbers. The Federal Reserve's policy decisions remain paramount, with past expectations of rate cuts being complicated by consumer inflation ticking higher in August, even as wholesale inflation showed signs of cooling. Meanwhile, the European Central Bank, in its prior September meeting, kept key rates steady, noting the end of the disinflationary process, but showing a mixed consensus among officials regarding future policy direction and economic risks. These diverging stances from the Fed and ECB are, as always, the primary engines driving EURUSD's volatility and overall trend. Of particular note is FexStreet's 2025 forecast, which painted a predominantly bearish picture for EURUSD, predicting a potential return to parity at 1.0000. Influenced by a strong U.S. economic recovery post-pandemic and the anticipated effects of a Donald Trump presidency, including proposed tax cuts and tariffs. However, the same forecast also acknowledged a possible rally towards 1.0600 or even 1.1000 if the EU economy were to show unexpected strength or the US dollar were to weaken considerably. With these significant fundamental narratives setting the stage, let's now transition to the daily chart to analyze how EURUSD has responded to these forces over the past year. Starting with the daily chart, we observe EURUSD trading in a relatively tight range during May and June of 2024, generally between 1.07 and 1.09. However, the latter half of 2024 brought a dramatic shift, with a sustained bearish trend taking hold from October. The market experienced significant downward pressure, highlighted by sharp drops like the -1.84% candle on November 6, and continued to depreciate through December. This period saw a decisive break below established support levels, pushing the pair towards the 1.03 area. This strong bearish momentum in late 2024 and early 2025 appears to directly reflect the FexStreet 2025 forecast of a dollar-favored macroeconomic landscape and a potential move towards parity. In January 2025, the selling intensified further, with EURUSD hitting lows of 1.014 on January 10th and 1.012 on January 17th. Coming remarkably close to the 1.0000 parity target. This 1.01 to 1.03 zone proved to be an extremely robust support level, successfully halting the decline and indicating a strong accumulation zone for buyers. The significant volume during these downward moves further confirms the strong conviction behind the selling pressure during this period. The repeated testing of these lows without breaking lower established them as critical long-term support for the pair. Contrary to the dire long-term predictions, EURUSD staged a remarkable reversal from February into April 2025, invalidating the immediate bearish outlook. The daily chart showcases a powerful bullish rally, characterized by consecutive strong green candles and a rapid ascent from the January lows. March 2025 was a standout month, witnessing impressive gains of plus 0.71% on March 3rd, plus 1.32% on March 4th, and an even more significant plus 1.6% on March 5th, indicating a profound shift in market sentiment. This reversal, potentially fueled by an improved Eurozone economic outlook or a less hawkish stance from the Fed, defied initial expectations and suggests that macro factors can shift rapidly. The pair aggressively broke through previous resistance levels, surging past the 1.08 barrier and continuing its upward trajectory towards the 1.14 region by mid-April. A particularly strong day was April 10th, where EURUSD experienced a staggering plus 2.8% gain, underscoring the strength and conviction of this bullish move. The rally continued into May and June, pushing EURUSD to highs near 1.16 to 1.17, effectively establishing a new, higher trading range and demonstrating significant buyer strength. This bullish phase suggests that the market may have factored in earlier bearish news and found new reasons for euro strength or dollar weakness, perhaps aligning with the alternative scenario of the FX Street 2025 forecast. The sustained rally also highlights that while long-term forecasts provide a framework, market dynamics can quickly shift based on evolving economic data and central bank rhetoric. Now, let's zoom in on the more recent price action using the 1-hour chart, covering late August through early September 2025. From this perspective, EURUSD has been trading within a relatively tight and defined range, largely oscillating between 1.16 and 1.178. This recent choppiness and lack of a strong directional trend align perfectly with news indicating limited movement and bullish momentum losing steam above the 1.1700 level. We can observe periods of slight bullish pushes, such as early September, but these quickly met resistance, preventing any sustained upward breakouts. On September 9th, for instance, the pair saw a notable decline from around 1.1768 to 1.1702, quickly retracing some of its earlier gains. The hourly candles frequently display long wicks on both sides, indicating indecision and fierce battles between buyers and sellers within this range. Immediate resistance on this time frame is clearly defined around the 1.177 to 1.178 area, which has capped upward movements repeatedly. Conversely, strong support has been established and defended around the 1.168 to 1.170 psychological level, preventing significant breakdowns. For short-term traders, a confirmed break above 1.178 or below 1.168 on sustained volume will be the key signal for potential directional plays. Otherwise, range-bound strategies might prevail. The market appears to be in a holding pattern, awaiting fresh catalysts to break out of this current consolidation phase. Taking an even closer look at the 15-minute chart for the most recent trading days, from late September 10th to the close on September 12th, 2025, reveals ultra-short-term dynamics. Here, the price action is exceptionally granular, characterized by small body candles, numerous dojis, and frequent overlapping, all pointing to intense indecision and a very tight trading range. The market consistently found buyers around the 1.170 level, preventing deeper dips, while upward pushes consistently faced selling pressure around 1.173 to 1.174. This pattern reinforces the lack of conviction seen on the hourly chart, suggesting that even intraday traders are struggling to find a clear edge. Volume during these periods is relatively low, further indicating a wait-and-see approach from larger market participants. For scalpers, identifying these ultra-short-term support and resistance levels, like 1.170 as floor and 1.174 as ceiling, is critical, but the risk of whipsaws remains high. A break above the 1.174 level on this time frame could indicate a short-term bullish impulse, while a break below 1.170 could signal further downward pressure towards 1.168. However, without a strong fundamental driver, such moves might quickly reverse, emphasizing the need for quick entry and exit strategies in such a consolidating environment. Let's recap our analysis of EURUSD. The pair has shown remarkable resilience, recovering strongly from late 2024's bearish drive towards predicted parity levels of 1.0000 to now trade in a tight range around 1.17. Currently, the price action reflects significant consolidation, indicating that the market is awaiting fresh catalysts. Key short-term support levels to monitor are at 1.168 and, more significantly, the 1.15 region from earlier consolidation. On the resistance side, immediate hurdles lie between 1.174 and 1.179. An upside breakout above 1.179 would signal renewed bullish momentum, with a target of 1.185 to 1.19, which we estimate has a 60% likelihood if supported by positive Eurozone economic data or a clear dovish pivot from the Federal Reserve. Conversely, A sustained breakdown below 1.168 could see the pair retesting the 1.15 level, with a 55% likelihood under conditions of strengthening U.S. economic data or increased hawkish rhetoric from the ECB. While the long-term bearish forecast for parity by FX Street in 2025 was challenged by the strong Q1 2025 rally, it remains a low probability, yet impactful scenario. 20% likelihood for 2025 year-end. If a significant global economic downturn or a pronounced shift to USD strength reemerges, potentially targeting the 1.03 to 1.01 support zone once more. Looking ahead, traders must closely watch upcoming high-impact economic releases such as U.S. non-farm payrolls, CPI, and any fresh statements or minutes from the Federal Reserve and European Central Bank meetings. These events are the most probable catalysts for breaking current consolidation and establishing a new directional trend. Furthermore, geopolitical developments and the ongoing U.S. presidential campaign, particularly concerning trade and fiscal policies, should be monitored for their potential to introduce sudden market volatility or reinforce existing trends. As always, exercising robust risk management, diversifying your portfolio, and patiently awaiting clear confirmations of breakouts or breakdowns from current price levels are crucial for navigating the EURUSD market effectively. That concludes our in-depth analysis of EURUSD today on Explain the Charts. Thank you for watching, and we wish you successful trading.